Good evening, everyone. I am Cristel Tita Aliwadang, and today I am going to report Chapter 7 about capital structure, an overview of the financing decisions. So, first of all, what is capital structure? According to Corporate Finance Institute, capital structure refers to the amount of debt and or equity employed by a firm to fund its operations and finance its assets. There are several important decisions to be taken under financial management. One of the important decisions is regarding the proportion of use of different kinds or sources of funds to be used. It is thus the financing pattern that should be chosen so that the returns are higher. There are three different sources of funds and they are classified as number 1, on the basis of duration or period. And under this source, there are also three kinds of duration or period. One here is short-term sources. It is the credit facility given to the firm for less than 1 year, and it includes all the operating expenses which are required for the day-to-day activities. Short-term finance sources help the enterprise to smoothly manage their day-to-day activities. That's why short-term financing is also known as a working capital requirement. An example for this is installment credit, like home credit, just like mobile phone installments, appliances, and so on. Another example is advances. In this, you have to pay the amount of the product before getting the possession. Gaya kung magpapatahi tayo sa maharlika ng mga uniforms, bigay natin in advance ang ating payment bago makuha ang tapos ng uniform. And last example here is accrued expenses, or those expenses which have been incurred but not yet paid, like outstanding rent and salaries. So let's take a look at disadvantages of short-term sources of finance. The first advantage of short-term financing is that it easily gets approved from lenders within hours. Sometimes, the funds are approved under one business day, but the key point is that it gets quickly approved. Second one is less interest. More the money lends for the finance, more interest the firm has to pay. However, in short-term finance, the firm has to pay less interest because of the less money involved. The third advantage is it helps in improving the credit rating. Short-term financing sources have the benefit of choosing these loans that suits their personal circumstances. This type of finance can be easily paid off by the firms, which help in improving their credit rating. In any firm has a bad credit history loan, they can easily improve that from short-term finance. And lastly, it offers flexibility and reduced stress. Short-term financing provides flexibility and reduces the stress of the firms. Now, firms can easily apply for these types of sources anytime without any stress because of less interest and easy availability. If there are advantages, there are also disadvantages of short-term sources of finance. First one is high-cost loans. Typically, in the short-term loans, you have to pay the high monthly payment. Mas maiksi ang term na pagbabayaran mo, mas malaki naman ang iyong monthly due. This may end by paying more amount of money by the firm to the lenders. Next disadvantage is the negative impact on credit score. As short-term loans help to improve credit score, but if you are not able to pay off these loans, it can also put the negative impact on the credit score of the firms. For example, na-delay ka ng bayad, mayroon ka ng penalty, at syempre, bad record yon na you are not paying on time. Last disadvantage is fall into the cycle of borrowing. The flexibility and easy availability of the short-term sources of finance makes you the habit of borrowing finance. Whether you need finance or not, it makes you spend more money than you can afford. Knowing na mabilis lang ang approval at alam mo naman na meron kang pambayad, kaya minsan na-addict ka na sa pangungutang short term. So, let's move forward to the second type of duration, which is long-term sources. It refers to the financing for the business that involves longer time to repay the loan. It finances the business for more than 5 years. Long-term finance is less flexible than the other finances because the finance of the source cannot be changed as per requirement, and this type of sources is less riskier than the other sources because of its stable interest rate and less temporary recession. It is also known as the capital budgeting decisions. For these types of sources, companies can avail large amount of finance since they require the collateral security or specific assets. One common examples of long-term finance source is equity share or also known as the owners of the company. These shareholders receive the dividend after giving the payment of interest and dividend to the preference shareholders. Another example is the retained earnings. After giving the dividends to the equity shareholders, whatever profit is being left out, from that, some part of the profit is retained for the future, and that money is known as the retained earnings. Just like short-term sources, long-term also have advantages and disadvantages. These are the advantages. Number 1, least costly. Long-term financing is less costly because it involves the less return and also the interest on the debt is a tax deductible. Secondly, enjoy tax savings. In this, the company also enjoys the tax benefits on the interest paid to the creditors. And lastly, no interference in business operations. The main advantage of long-term sources of finance is that creditors have no right to interfere in the operations of the business. While the disadvantages are: number 1, permanent burden to the firm. Long-term debt makes the permanent burden for the company by paying the interest rates for a long time. Kasi kung mas matagal ang utang mo, mas malaki din ang interest. Habang tumatagal ang utang, ang burden doon yung interest na maidadagdag. Whether the company earns the profit or not, the firm has to pay the interest. Otherwise, the creditors can claim on their assets. Next one is, it has the fixed maturity date. Kasi meron kayong agreement na pinirmahan kung kailan ang maturity ng iyong loan. And last disadvantages is the riskiest source because the company has to pay the interest to the creditors at a fixed time. Non-payment of interest can lead to bankruptcy for the firm. The last duration or period we have here is a medium term. A medium term is a term used in investment to describe an investment holding period of between 1 to 3 years. The time horizon in a medium-term investment is intermediate. The investor is expected to receive the return on the investment and the initial capital with 1 to 3 years. The main purpose businesses use medium-term finance is to finance expansion projects or purchased fixed asset. How does the medium term work? Medium-term assets or investments are held by different investors for various purposes. For instance, an individual investor can buy medium-term bonds to cater for expenses that might occur in the immediate future, such as paying children's school fees, buying a property, or starting a business. Medium-term finance, as compared to the other two options above, have 4 limitations listed here. Number 1, more difficult to obtain. Medium-term finance is more difficult to obtain as compared to short-term finance. That is because the financial institution or lender providing the loan will generally require the business or borrower to meet a specific credit rating. Similarly to long-term finance, some types of medium-term finance may require the business to offer collateral in exchange for the loan. For small businesses and startups, that may not be possible. Second one, longer approval process. Due to the extra checks on the borrower, medium-term finance may have a long and lengthy approval process as well. Apart from the checks, lender may also require some other extensive documentation that supports the financial capacity of the business to repay the loan. For small-sized businesses and startups, this may take even longer due to no credit histories. Therefore, medium-term finance can be disadvantageous for those businesses looking for quick ways to finance activities. Similarly, the lengthy process does not guarantee a borrower will receive the loan. So, the borrower always faces the risk of waiting through the process and not obtaining a loan at all. The third one is higher fees and penalties. Some forms of medium-term finance may also come with high fees and penalties. They may consist of origination fees, which includes cost which the lender incurs due to the processing of the information related to the borrower. And lastly, accrued interest. Medium-term finance may also result in high accrued interest for the borrower, and it depends on the interest rate of finance. So in conclusion, businesses can obtain finance for different periods. Most commonly, they use short-term and long-term finance. However, they can also use medium-term finance, although it is not as common. Both these sources of finance play an important role in business. On one side, helps in managing the working capital of the business. On the other side, it helps in providing the fixed capital for the investment in fixed assets. The organization should make the balance of both these sources for smooth operations of the business. Moving on to the second sources of finance, which is the basis of ownership. And under this source, there are two kinds of ownership. One is owner's fund. The owner's funds are the total amount invested by the owner of an enterprise and the accumulated profits that they have reinvested in the business. This money remains invested in the business till the company winds up its operations. It is the primary source of funds, without which it is difficult for any organization to survive in the market. The owner may be an individual, a group of partners, or shareholders in the business. The capital invested by the owners allows them control over their business. Some entrepreneurs may prefer to keep the control of the company to themselves, while others may opt for sharing the control and risk of a business by bringing in other investors. The next type of ownership is the borrowed funds. The borrowed funds are the funds that a business raises through loans or borrowing from other parties. They are the most common sources of capital for any enterprise. Some of the methods of raising borrowed funds are as follows: raising loans from commercial banks or other financial institutions, issuing of debentures and bonds, public deposits, and trade credit. A business can avail these funds only under certain terms and conditions, which they need to fulfill at all costs. The borrowers must also pay a fixed amount of interest on these funds to the lenders, irrespective of whether the firm is making a profit or not. In most cases, the creditors give these funds on security of assets of the firm. And we have the third and last sources of funds. the basis of the source from which they are generated. And we have here the internal sources. Finance is the blood of any businesses. Operations of an entity start with the capital, the first source of finance, and end with liquidation proceeds, the last source of finance. Finance can be arranged through internal as well as external sources. Each option of finance has its good sides and bad sides, considering the cost of finance, implications of taking the finance, legal implications, and many more. As of now, let's drill down into the details of internal sources of finance. And this refers to the internally generated cash inflows through its business operations or fresh infusion of capital by the owners. It is also characterized by no dependency on banks or lenders for building the capital needs of the company. And lastly, these include retained profits, sale of operating assets, issue of capital, and lending collection of debt. And we move to external sources. External sources of finance are those that come from outside your business. External financing comes from outsider investors, which can include shareholders or lenders who may expect either a percentage of the business or interest paid in exchange. The commonly seen example of external financing is the sale of shares in the business, which invites investors to put money into the business. In summary, capital structure is the financing pattern which the company chooses from the funds based on ownership, owner's fund, and borrowed funds. These funds are different in the risk and cost. That's why it is very important for a company to properly analyze the position of the firm and other factors before making any decision because it can affect on its profitability, liquidity, and financial risk. Other factors such as cash flow position, flexibility, control, regulatory framework, and stock market conditions are also important and should be considered before making the decision so that there are no regrets later on. As good decision saves time and resources. That ends my discussion on overview of the financing decisions. This is Cristel Tita Aliwadang signing off.